Hey everybody, welcome to This Week in Pre-IPO Stocks Podcast. With me, I got Nick Fusco, CEO of 8View, a pre-IPO secondary market pricing company, and Clint Sorenson, Chief Investment Officer at WellShield, an outsourced CIO and investment research company. Okay, we've got two topics today. We're going to talk about some IPOs. We're going to talk about secondary sales picking up and kind of VCs and LPs looking to sell some of their stakes. And then also maybe we'll look real quickly on Cohere. They got a big employee sale. They actually hired Morgan Stanley to get out. So, all right, first let's talk about the IPOs. So just a quick recap. We got ARM, Instacart, and Klaviyo all coming public this month. A whole bunch of data has come out over the last, I'd say, week, and really some more data to this just today. This is Monday. We're taping this on Instacart and Klaviyo and ARM. There's another piece that just came out about an hour ago. So one, I want to open up to the crew, like I know, Nick, you and I have been talking about this like multiple times today, right? But Clint, I'm interested to get, I'm sure advisors aren't like buying IPOs, right? But when you're talking to your advisor clients, what's the buzz? How are they feeling about these things? Do they view this as like a positive sentiment that these IPOs are coming? Like what's the buzz?
Yeah, most of that comes from just my conversations with the advisors, and I've been speaking on the space for a while about how, once liquidity trends change, and I'm not sure they have or whatever, you got to measure that kind of in hindsight. But one of the things we like to look at is where there's been the biggest dislocations, and we feel like pre-IPO equities have had tremendous dislocations. Instacart being one of them, right? Look, where did they price it at? 9 billion is where the
9 billion.
Yeah, 9 billion is at the high side, and then what was the last round, Nick?
So last round was 39 billion. I got it here. It was 39 billion in March of 2021. And then they had an internal valuation number in March of 23 at 12 billion.
So, think about that. Think about that. It's pretty amazing what we've seen in terms of price pressure there. And I think that that's a significant opportunity to pick up some of these businesses. So I like it. I can't wait to see kind of what happens in the IPO market. That's a different animal, right? What happens kind of post IPO. But I think this is going to be a good test to say, hey, with all the Fed tightening, with the bank tightening, and with all the kind of turmoil in terms of liquidity preference within private equity and venture capital this has been a dead market for a while. It'll be nice to see if this can bring it back to life. And
yeah,
I'm liking the activity so far because I think we need that. We need that functioning funding mechanism, something we've talked about on this call before. And I think that's critical. So it'll be interesting to see kind of how successful it is after the fact, but I like the activity.
That's cool. All right. So Nick, I went in and took a look at 8View, right? From the last, kind of primary round to, today, right? Or last week, when you guys updated the numbers. So like Instacart, I had them around 12.6 billion. And as Clint mentioned, they're going at 9, right? So one could argue that has a little bit of room to run perhaps, right? Once it hits the public markets. Klaviyo was a little bit different. The number that I came up with the data there was 4.3 billion, and they're coming out at 6.8, right? Their last primary round was 9.5. So what do you think? I know you've done a lot of research from when, these stocks start to go, the pre-IPO stocks get announced and they're going to go public, and like what happens there in the secondary write-up as the run-up. But what are you thinking about how these things might do once they hit the public markets?
Yeah, so hitting on the Instacart thing first, we always think, is the market going to accurately price this for the IPO? And really interestingly, you hit on the $39 billion valuation from the previous round. The round before that was still over 10 billion. So
right.
That's another mark in time. Then you've got us at like your 12.5-ish. You've got the 40X marking it north of where 8View's marking it. So you've got 4 different very powerful marks suggesting where this is going to price. And then it's probably going to be at around that 9 billion is what Wall Street Journal's coming out with.
Yep.
I think this thing's going to pop as long as they don't flood the market with shares.
Yeah.
So if they're really just trying to get liquidity for the existing employees and not bringing in a ton of other money, I'm really bullish. I think they want to see this fly and set a precedent for the market and just let the thing rip. I hope that's the case. I really do. Klaviyo, I'd see a little bit different because you've actually got 8View on the low end versus the the prior round and the 40X, which are on the higher end.
Okay.
And the IPO is like sitting in the middle, which is pretty interesting. So yeah, indicatively, I think it also just depends so much on how many shares they're bringing to market and how they're going to do on that roadshow. And then I think you wanted to bring up ARM, where the roadshow was 6x oversubscribed, and now they're saying it's 10x oversubscribed.
10x, yeah.
Yeah, so this is
crazy.
This is remarkable, but we have to see some wins here.
Yes.
And yeah, I've always focused so much about, okay, how can we look at pricing the IPO the best? But maybe the best is actually underpricing it and just letting this thing fly and bring the health back to the market as I think all three of us really want to see, right?
Yeah, get some momentum.
Fellas, come on. You're a banker, okay? Put your Goldman Sachs, Morgan Stanley hat on, okay? You're a banker. There's no IPOs for like the last 18 months, 2 years.
Hungry.
These three guys come. Are you going to like to Nick's point, I don't think you're going to mess around with this. You're going to like, these things got to go so that there'll be more behind me. So they're I think they have to be. I mean, there's a little like, that's a little like, you got to put your client first, right? But I mean, I'm sure the advice is leaning towards the lower side, right?
On the Instacart, it's all those heavy hitters, man. You roll through the S1, it's
the big dogs, right?
Yeah, exactly right.
And what they're going to tell them too? They're going to say, hey, come out, raise a little bit of money here, and then we can do secondary issuance later on down the road, right? At a higher valuation. It gives you, there's a lot of what used to be single steps capitalizing on a very liquid bullish market, flooded market from a liquidity standpoint, to now it might be like multiple steps to kind of achieve funding goals. And that wouldn't be a bad play here for the bankers or for the company probably.
And Clint, to your point though, like they also, all three of these look like they're going to have really strong pipes, right? Coming into some big institutional players. So like you could tell like the bankers are being really thoughtful about this, I think, right? And where they're being priced and how they're going to need institutional support to come in and price them. I mean, there were people talking about ARM. So all right. So SoftBank owns like 65% of ARM, right? They came out last month. They bought another 25% at $65 billion, right? Then the bankers come out and say it's at 52. It's 10x oversubscribed. So I don't know what that translates into once it hits the public market, but I have to imagine it's going to be well north of 52, right? If they don't even move it up before then, right? Now they're talking about moving up the price, the valuation. So this is good, man. I'm excited because I think this happens. Like, let's talk about this. Let's say, touch wood, all three of these go and it's good. Like we come back in 30 days time and they all look good. I talked to a guy today. He's like, well, you got to really wait 6 months to see what the blackout window is. I'm like, I don't think anyone's waiting for that. I think that's going to be like 30, 60 days. And then people are going to be like, okay, it's game on. Right. That helps the private markets, I think too. Right. It helps with money coming in. I mean, do you agree? Or it helps with secondary transactions. Like the world is right again. Things can happen.
It's a liquidity source, right? And everything functions on liquidity. So this is just this is a mechanism for liquidity, and we need it in a epic tightening period. Yeah. In IPO space, and I think this would be awesome if it goes through.
Okay, this is like a perfect dovetail into this next item. So to your point, Clint, on liquidity, there's an article that came out today in the Information about literally VCs selling stocks in the secondary to get liquidity and LPs selling their LP interest in VC funds to get liquidity, right? So liquidity is a premium, and you can tell, like, to me that means that there's probably some portfolio management stuff around here. And you, Clint, maybe you could talk about that being a asset allocator, right? On how you kind of have to think about asset allocation if your allocations are not balanced, right? But I mean, Nick, like these guys, like Tiger, like most famously this past week, Tiger's outselling Cohere, right, in the secondary. I don't know why you would sell that right now outside if you need the cash, because you either see other opportunities, right, or you got to report wins back to your investors, right? You got to show a win, post a realized gain. I mean, is that? I view this as very positive for the pre-IPO space, that there's like transaction activity happening and LP interests are being sell. Like, what do you think? What are your thoughts on this kind of secondary market activity picking up?
Yeah, I'll hit on the points you just raised. I think you absolutely have to show some wins because, I mean, at least we'll use Tiger as the example. They've been dragged through the mud in the press about how far down their funds are, bringing Cohere to market, getting a good price on it. That's going to be a great win. And I think some of this is very, very healthy for the market as a whole, whether it's kind of direct purchases or LP stakes, for exactly that liquidity, like you're raising liquidity. And also a lot of us are realizing there's like extension risk here now, right? We're worried about duration on these holdings because they're not IPOing. We're not having those Klaviyo, ARM, and Instacart events as often as we might have wanted or expected from history. So all of this kind of just makes a lot of sense for investors and the funds themselves in my mind. And I know, I'm half expecting Clint to want to hit on the duration aspect of it too, because I come from a fixed income background, right, originally, and that was always so important for what we would look at. Yeah.
So Clint, talk about that asset allocation dynamic, right? Where, you can't really rebalance venture capital. And I think these guys, this is effectively what they're trying to do.
Yeah, and I can't speak for all of them, but a lot of them are having tough times raising capital as well. So when you start to think about, hey, I've got, I want to rebalance my portfolio, or I want to buy, let's just throw a name in there, OpenAI or something like that, right? And I've got to get some liquidity. I'm going to go out there and sell some stuff, and I don't want to take a loss on what I'm selling if I'm already been drugged through the mud, so I got to sell. This is what happens with the preference to liquidity, where you sell what you can and what's hot versus what you want to sell. And I think that's happening across the board in all private markets, not just pre-IPO equity. We see it in real estate too, right? Mm-hmm. In terms of real estate managers, they can't go out there and sell the ugly properties in the portfolio. They got to sell their high quality stuff now because you have a drawdown, you have a liquidity preference. So I think that's happening across all assets that are not quote unquote mark to market, every day. So all non-public assets. And so I think that is what that's kind of in my opinion, the fundamental backdrop of this. I think to Nick's point, it's a great point, is the duration piece as well. All duration got extended last year, and everybody quickly realized how much duration they were holding in their portfolio when you had interest rates move up and you had massive market losses. So when you look at the pre-IPO space, what was the 8-view index down in 22, Nick?
22. Oh man, you're putting me on the spot.
Sorry, I'll think you come back. It was down. So it was down, significant, right? And when you look at that significant drawdown and you think about that coming on the back of interest rate moves, that is your duration play. That's telling you how much duration these things have. They moved down significantly more than, say, the S&P 500, right? And I think that is, and with the Fed set to be tighter for longer, inflation starting to reaccelerate again, it's not a great situation to be holding duration on the portfolio. So a lot of these portfolio managers from an asset allocation perspective got to pull that in. And so that whether that's pulling it in and adding liquidity to the balance sheet, or whether it's replacing it with something else, I'm not sure, but I know that's probably going on.
Yeah. So
okay. So just in general, though,
38%. Sure. So I'm just saying we're down 38% in 2022, just for reference. And sorry, go ahead, Aaron.
No, so like not a great year, I think, to your point, right, Clint?
Not a great year.
I got you.
It just showed you that you had duration, right? Because what caused asset prices to go down? It wasn't like you had a credit event.
Yeah.
What happened was you had the Fed tighten policy and move up the cost of capital, and that duration became apparent in all assets, and in particular growth assets. And when you think of growth, you think of pre-IPO equities, right? So I think that was case in point what occurred. And I think to Nick's point, which is a great one, I think a lot of these portfolio managers are more mindful of that now if they weren't before.
Right. Yeah. But go ahead.
I think this is a wild thought or an analogy, but if you click it back to like 2008 or 2010, the asset-backed crisis, you actually have exactly this idea of the ticking time bomb still set up in some of these portfolios. So I'll do a really nerdy example for anyone in the UK listening, but there was something called the Granite Master Trust. And it was the bad mortgage assets in the UK As the good ones turned over, the bad ones maintained and stayed in the portfolio for exceptionally longer until the portfolio just got worse and worse and worse over time.
Right.
And this could be, I'm not going to say it is, but it could be part of what is occurring here if there is more liquidity on individual assets within a portfolio. So now we're spinning out of Cohere and we look great on paper because Cohere did great. Guess what? The rest of the portfolio is just a little bit worse than Cohere. And then a little bit worse and a little bit worse as we unwind. So that could both extend the duration even further than what we're thinking, but also leave kind of the dregs to sit there as we're pouring that glass of wine, right?
Well, look, if these guys were smart though, Nick, they would like reset. If these guys were they're smart. They are smart.
Yeah.
But like, one approach to take is you take a gain. I mean, Tiger is different. They're like publicly, they're like a hedge fund, so they're marking the stuff to market probably much more frequently than a traditional like venture capital fund would. Right. But if you're a VC fund doing this and you're marking stuff to market, I think you would want to, sell this Cohere stake or whatever you're selling at the gain, and then also maybe move down some of these other marks. So it's, you're balanced. You can still send cash out, right? This is like maybe a little inside baseball portfolio dynamics, right? For VC fund, you can still send the cash out to your LPs if you want to show like distributed paid in capital. But now when you report your, TVPI number, total value of a portfolio paid in capital, that could be a little bit more balanced. Right? Where you're marking down some of these other things. So hopefully, to your point, Nick, you're kind of realizing some of the bad, right? At the same time as you're bringing in some of the good. And I think that's like a smart approach, especially if you don't think the bad stuff's going to come back up again,
Yeah. But also you want to look at, every one of these portfolios is going to have a pricing protocol and a valuation committee, right? And if they maintain course and don't adjust or take into account what is actually occurring in the market, they might not do what you're saying, even though
I hear you.
Like if you're a mutual fund, 40X fund, Rule 2A5 says you have to periodically assess the approach of fair value on your fund. You don't have that same thing if you're a VC. You know? Then you have the private fund advisors rule that's going to do maybe help a little bit, quarterly statements, things like that.
Yes, but come on.
If you don't do it, you're kind of showing a gain and not showing some of the issues internally. And I think that balanced approach that you're saying is brilliant. That should be.
But Nick, we did this big episode on these new private fund rules from the SEC, right? You can tell they're marching the private funds closer and closer to like normal, public market 40 Act funds. I don't know when it's going to happen, but I can see, if there is a third party mark available, like an 8view, right? For example, like you should be using it.
I appreciate the
I don't know if you can do that for real estate or some of the other asset classes, but you would walk us through that framework, right? Of different types of marks. And I could see them tightening that stuff up and kind of, almost like pushing people into certain directions where you just can't mark this stuff yourself. If there's, industry known third party mark that you could be using, right? Instead.
Right.
And you have to have a really good reason to justify not using it. Right.
I think the independence is key. And a lot of the cases you can already have independence, but it's very expensive, right? So if you go and you get an external valuer, there are a number of shops that do it. They could charge anywhere from like $10,000 per year to get one level, And
but I I like what you guys have. Like if I had to pay somebody, I'd rather pay like an 8view because it's real pricing, right? Real market pricing than paying somebody on a spreadsheet to rip something out. If that option was available, like I said, if it's real estate or something else, maybe you can't do that, right? You gotta pull out the spreadsheet. But real world marks are much better than some theoretical thing on a spreadsheet, in my opinion, right?
We tend to agree.
Yeah. Okay, cool. Well, look, I will say this. Clint, do you think most advisors even know that they can buy LP interest in a venture capital fund, private equity fund, real estate fund?
Nope.
No one knows about this.
Not many. I know some, but they've usually been in the institutional realm before they got into private wealth. So they added private wealth and they'd maybe used a fund. There's some really popular funds out there that specialize in like secondaries, so LP interest in funds. And so I think that those advisors are the only ones I've ever heard talk about it. Other than that, I've never heard someone talk about secondary interest in a fund.
Yeah, I think it's very interesting, and it's a very interesting, way to get access to the asset class or managers, right? If you want to put like your manager selection hat on.
Yeah, top tier managers. I mean, I talked about this on our trend report this morning. I think there's going to be a significant opportunity in the private equity, private debt, venture capital space for these secondary LP interests, because they're, volatility and returns tend, the starting points, so call it expected returns, but volatility and expected returns tend to cluster around these liquidity events.
Right.
And if you are in the position to provide liquidity when there is an overage of liquidity preference, especially among astute institutions, that historically has rewarded the liquidity provider. And I think we're there in a lot of, especially in like real estate, we're there in a lot of asset classes, and the opportunities are just compounding. We haven't seen it fully yet, in my opinion, in the venture capital, private equity, private debt space, but I think it's coming. And I think obviously it's coming, right? We're talking about it here.
Yeah.
But I think that's a significant opportunity to pick up top tier managers and be that liquidity provider for advisors and their clients or institutions who want to take advantage of the opportunity set.
Yeah, I think this is going to be a bigger. There's actually, I was doing some research on it. There's some tax implications for like the fund itself. So you got to like navigate some of this stuff. But, there's a lot of smart people out there. So I'm sure someone's going to figure out a way to get this done. And Lord knows, with enough legal fees, you can pretty much do anything these days, right? So I'm sure that's coming down the pipe. All right, last thing I wanted to hit on. There is a firm called Cohere. They basically buy NVIDIA chips and then like sell them, right? It's like not resell them. It's like a AWS. They literally just buy NVIDIA chips, put them together, and then like, rent out some AWS type space to third parties to train a large language model AI, right? That's their business. So these guys naturally have done very well. They're out selling. The employees have got together. They're out selling shares. They're literally taking chips off the table. Okay. They've hired Morgan Stanley to go out and sell $500 million of employee stock at a $6 billion valuation. All right. So this has been like traditionally a huge no-no for like VC-backed companies to go out and sell, employee shares. Like, you don't believe in the company, because I'm sure there's a lot of the executive team that's participating in this, right? I can't imagine it's like, the junior analysts that started with them, right? It's just like a lot of the executives are selling this in this position. So this is kind of changed. I also think, though, this is really interesting. You talk about private companies staying private for longer. Now they're getting liquidity for employees, right? I mean, there's a whole bunch of different interesting dynamics that come into play here. Like, so the reason I bring this up, I feel like the world is like shifting, right? Yeah, man. Like, so I was reading an article on the Journal today. I think it was the Journal about like companies not going, but the number of companies just going public in total. I'm not talking about the freeze over the last like 18 months. Just in general, it's like they're not going public.
Yeah,
right?
The private market's so much. It was at 9 times larger than the public market. It's insane.
It's insane. But
and
I feel like
it used to have a valuation flip. You used to have you could achieve a higher valuation in public markets. So that's why you went public. Now it's flipped. Now you've got higher valuations in private markets.
Yes.
And you're taking a hit to go public.
Yes.
And so you're almost waiting till you're just so large that you literally, at the end of the day, you'd be in the S&P 500 and you've got to take chips off the table or raise capital. And you're just too big for the private markets at the time that you need the capital. I think that's more I think that's what we're seeing. I think we're seeing those symptoms.
So Clint, would you agree though, that this is what's different now from maybe like 10 years ago around the size of it's these growth companies aren't going public, right? Mm-hmm. Like they used to, like Google and those guys, like you'd hit unicorn and you would go public, $1 billion public. You'd like, I'm going to go public, Russell 2000, right? It's not happening anymore. So like
access wasn't as big back then, right? Now you've got more access points.
Yeah. So Nick, you got like a ton of companies, private companies that you're tracking, right? In your, database. How many companies is that? It's like 30 companies, 40 companies? I mean, you gotta have a lot in there,
Yeah, so
right?
we get data on in excess of like 700 or 800. And then where the
Wow.
data becomes corroborated, that's where we start to push it forth. So it's
Okay.
maybe a smaller fraction of that we actually have the confidence to publish, but it's growing. We'll say that much.
Okay,
We're
so
having
just so
more companies join the gang of being
yes.
priced privately than actually going to IPO.
Okay, so what does that mean though? So just so everyone understands what that means, like AView has these broker relationships, right? They send you data. And there's people either they're putting like bids or asks out there. So they're making, they're putting out, they're trying to transact, right? And that's
Exactly.
coming through that space.
Any form of liquidity going through institutional size broker network. So these are trades that are 1 million to 200 million size, typically around like the 15. So they're pretty big clips out there.
Okay.
But that trend we are seeing even other brokers spin into their own new shops. You're seeing more large bulge bracket banks that never had secondary desks before because they always focused on the investment banking primary rounds. Hey, guess what? They have secondary desks now, and they're going to be really investing in those. So this is just an area of the market that's not going to go away, right? Look at other asset classes. Like loan syndication is so big, and then you've got loans that are being utilized for CLOs. Guess what?
Right.
Massive secondary market for both loans and CLOs. This isn't going to be that different. And I do think, the pause to delay until you want to go public, maybe even one of the impetuses could be, hey, we are just so big and so valuable at this point. We're too big to be bought. So there's no M&A activity after 5 billion or 10 billion. So you got to go public. That might be the last option. And but if you don't need the cash or you don't need the liquidity, then maybe you keep doing it forever. Depends on the makeup of the company, right?
The big tell though, like Clint, like put yourself in like a big VC fund shoes, right? Someone runs up. If you had the opportunity, like one, you could wait for a liquidity event, but if you could start to sell shares in the secondary market and that like wasn't a huge pain in the ass, like why would you not do that?
I would always do it. You got to record the wins. You got to take wins. You got to put them down. I would try to, obviously it's harder in this asset class, but I would try to sell my trash first, the underperforming asset classes. So I'd try to run more of a momentum portfolio than a non-momentum portfolio because I'd want to make sure I had the winners in there. But at the end of the day, I would be trimming and selling along the way. Every round I would be taking chips
finding
off
a way.
Yeah.
It's that mentality I just don't think exists right now. But I would offer with like GPs of venture capital funds. But I would offer though that I think like stuff like that's happening, and also what we discussed earlier with this VCs and LPs starting to sell. I mean, I have to imagine that has got to feel like it's becoming a little bit more acceptable, right? At least it appears that way. So I just like, look, I mean, you're a financial advisor. You're helping an employee of Cohere, and they come in and they're 32 years old, right? And they're worth $20 million on paper, right? You know what I mean? But they have, $75,000 in cash in their bank account, right? And it's like, brother, like, like, why don't you sell $5 million here, right? And like take some money off the table, because Lord knows this thing could just toilet bowl and you got nothing. Like you could have more money than most people make in their whole lives, like in one transaction.
We saw it all the time in 2021. I can't tell you how many horror stories we saw where companies either went public and these young execs had tons of shares, a lot of money on paper, or they struck it big. I know one family struck it big in a big non-public company. And at the peak valuation on paper, they're like, oh my goodness, we've got all these estate planning issues now. And then it goes away really quick. I mean, I can't tell you how fast that changes, and it's detrimental to people who pour their life into this company, because everyone has that same bias when they work for a company. I'm overweight the companies I own, right? Or participate in. Everyone ends up overweight. It's not a textbook where we're all going to allocate perfectly, right? So you end up overweight the things that you're working with and that you know, and there's a lot of strategy required to protect those gains when you get them on paper.
Yeah,
and most people don't do it. And I think
you should be ashamed to sell. Like, I don't think it's like, take the negative stigma off of it, right?
Yeah. Well, I mean, there's hedging. There's all kinds of stuff you can do properly without having to sell it to protect the value you've gained, right? There's all kinds of structures you can set up and put in place in ways to leverage that wealth to protect it. And I don't think enough people do it. I mean, we saw it in, I'm not going to name the name of the company, but the executives with a certain EV company where tons of money, then all of a sudden the stock gets murdered last year, and that tons of money turned into very little money. And so it just changes their entire outcome quickly. I've seen it in companies where public companies bought a private company and they got shares for half the deal, and then the company dropped 80% and they didn't hedge or do any things to diversify, and they're sitting there left with significantly less wealth than they had when they had originally sold their company. This happens every day, all the time. And it's a challenge.
Yeah. So, I mean, that's a human narrative though. Cause I mean, we're talking about these companies now, but like, Exxon, same thing. I mean, you heard the horror stories with Exxon.
Banks in 08.
Not to date, not to date myself, right? But like,
Yeah.
You hear about like the poor woman who worked at Exxon for 40 years and then, went to zero bankrupt, and then she like lost everything. And, so it's very sad, right? But part of you is like, why did you do that? Like you should have sold some stuff. Why did you have everything in Exxon stock, right?
Look at what happened with like Wachovia, the bank that I started at, right? Or, I mean, I know a lot of people had their entire net worth in that bank stock.
Morgan Stanley was like that too. A lot of guys were like underwater on their options. It was like very sad, actually. I felt bad for everybody that had.
Yeah, you and I have a mutual friend that happened to. It's tough.
Yeah, man. So but look, this is encouraging. I actually love that these guys did this.
Yeah,
right?
Get some liquidity. If you can get it, take it.
And I don't think they should feel bad about it either. Like, I mean, I don't know if I'd sell 100% of my position, but take some money off the table. This is like a once in a lifetime thing. Most people never get to experience this, right? You should just do it. You shouldn't feel bad about it. It's okay.
You've literally hit the lottery. Go ahead and cash the lottery ticket in.
Just do it, man. Just do it. So, anyway, I hope everybody gets an opportunity to make that decision at some point, right? But we'll see. All right, what else? Anything else on your guys' mind? It's all IPOs for me. That's all I can think about is these 3 IPOs. I can't sleep at night. I'm just dying to see what happens. They're supposed to come like in the next week or two, so it's going to be in the news cycle.
Let's cheer them on, man.
Man. I hope they rip and everyone makes a ton of money.
Right. And then portfolio allocation, right?
Yes.
Reallocate.
Yes.
That's a big one. I was on with a fund administrator today. It's all about the allocation per percent per company, and marking those appropriately relative to where the funds were giving them. So that hits on everything that Clint was saying and you were saying for the last bit. You hit the lottery.
Yes.
Let's diversify and grab a few other assets to mix it out. So
yes,
I think that's a great.
And let's do it in pre-IPO equities, right?
Precisely right.
Come on,
let's do it.
Let's go. I love it. All right, well, gentlemen, thank you very much for your time this week. This is a great conversation. This market's dynamic, man. I love it. I love how it's expanding. So there we go.
We got a guest.
We needed a fourth today.
We needed someone. Yeah.
That's right, man. Hey, buddy. All right. I love it. All right, gentlemen. Thanks for your time.
See you guys.
Have a good one.